Bitcoin was so beaten down by the whole, crypto fraud, FTX, all that stuff that happened last year. So if anything, it was earlier this year, you kind of had a partial recovery just because you had super oversold levels. You had a lot of kind of long-term people kind of coming into the market, buying it, pulling it back up. I still think there's a lot of froth that has to bleed out. I think we're obviously seeing more and more regulatory hits against that space. Basically, is they define what is a security, which assets have violated security laws. Yeah, the main difference is that this is more of a duration challenge compared to a credit challenge. So back in 2008, going into that event, you had basically generationally low cash and safe assets on bank balance sheets relative to their riskier things like loans, things that can actually default. And obviously, they did run into a default event, so they risked their whole bank capital getting wiped out by these series of defaults. And it looked in many ways very similar to the 1929 crisis. The 2008 crisis and the 2010s aftermath were in many ways very similar to the 1929 crash and the whole 1930s aftermath. This one's different in the sense that it's at least so far, there are certain pockets of credit risk, but the main thing hitting banks is that they invested in very safe assets, but at wrong prices, and now they're facing their deposit rates going up, they're facing unrealized losses, and then they have a challenge where they can hold those assets to maturity, but the market doesn't always let them do that, especially if they have deposit runs and things like that. So earlier, last month there was a liquidity crisis. Now I think it's evolving more towards a profitability problem because, while the Fed and others have these facilities in to prevent ongoing liquidity, or at least reduce the severity of some of these ongoing liquidity problems, banks now face an issue where, they have some of these long duration assets that might be relatively safe, and many of them are, but then they have rising deposit costs. If you look at the Federal Reserve's own balance sheet, they're in the red. They're operating at a loss now. We're seeing the slow motion version of that happen to the commercial banking sector, where their deposit side is slowly kind of catching up with a big lag compared to where the Fed's own rates are. And you see that more so happening in the long end of the medium and smaller banks, whereas larger banks have more overall position to not really raise rates as quickly because everybody wants an account at those bigger banks. And so right now there's a kind of, I think, an ongoing profitability problem among those small and medium-sized banks. I think the challenge they're running into is they actually took a different course in the playbook. Last time they did basically what Japan's doing now, the yield curve control, raise things slowly. This time they tried to rip the Band-Aid off and just jack rates up. And basically it's emanating into the banking problem, and it emanates into real estate. And I think we see these cascading problems. And I think the challenge is that they eventually face kind of a Minsky moment where they're not able to handle both at the same time, with the key difference being that we are in a different technological environment now, where we have social media, we have rapid real-time data, we have more free flow of capital, at least for the Western world. And I think that's the challenge they run into, is that they're essentially applying a 1970s kind of inflation fighting playbook to a situation that's actually more like the 1940s. And I think it will result in some pretty extreme outcomes. That they're going to have pretty insane decisions ahead of them, where sometimes they're facing both inflation and recession problems at the same time, or at least kind of back to back. And it's the worst possible environment for a central bank to navigate, because if they have a 1970s style problem with low debt and high inflation, the answer is to tighten. Whereas if you have the combination of very, very high debt levels and inflation, that's when they face kind of the impossible scenario. I am very cautious on equities for the next several months. I think that there are attractive areas longer term, but until we have more clarity on this liquidity situation, we see basically a storm on the horizon. It's unclear how they're going to handle it. Now, if the market correctly sniffs out to say the Fed's going to blink and they're going to pivot their liquidity, kind of like they already partially did in March, it's possible the market, say, front runs that, and then it never gets the big sell-off that some of the bears expect. And that's part of why this is a challenging market, because it's so human driven. We're basically trying to predict what a handful of individuals like Yellen and Powell are going to do. One or two things has to happen. Either the Federal Reserve might have to provide more liquidity which is awkward given their current inflation mandate. Or the Treasury, for example, can shorten their average duration of Treasury issuances and try to draw liquidity out of the reverse repo market. But that also, it doesn't make sense from a number of standpoints. That's the most expensive part of the curve right now. So I think that's going to be a big challenge for them. And it's just this multi-month period of, we see decelerating profit margins, we see decelerating growth, we see across the spectrum. If you look at all these different parts of the economy, we see labor starting to weaken to varying degrees, even though that's traditionally a lagging or coincident indicator compared to some of the others. Even that one is beginning to show somewhat fairly early signs of weakness now. And I think a lot of recession indicators are kind of pointing towards that same part of the year, as you pointed out, with the liquidity crisis. And I think that cash, T-bills, cash equivalents, not relatively low volatile stocks are ways to maybe weather the storm until we have greater clarity on how they're going to handle these kind of extreme environments. And so basically, some people, what they do is they put Bitcoin in a different segment where they say, this is something I'm not going to touch for a certain period of time. Kind of like how if you have physical gold in your house versus, say, a paper gold in your portfolio, you might treat them differently. You might say that the physical gold, I'm not going to worry about the price. I'm not going to worry about timing anything. Whereas the paper gold, I might try to do that. I think this is the same for Bitcoin. I think there's, if you define yourself as a Bitcoin trader, you want to focus heavily on things like liquidity. Generally, liquidity and economic indicators are better. So, if you put it simply, if you buy Bitcoin when the PMI is rising, you're going to have a better time than if you buy Bitcoin when the PMI is falling. And if you want to get more precise than that, if you look at various liquidity indicators, they generally front-run PMI a little bit. And Bitcoin also tends to front-run PMI a little bit. So actually the closest correlate that I've generally found for Bitcoin is various measures of liquidity, both domestic liquidity and then global liquidity, including, say, dollar-denominated global M2 in rate of change terms. Those are the types of things that correlate heavily with Bitcoin. You can look at things like, what percentage of the supply is liquid versus like tightly held. What are the developments happening on that whole ecosystem? So what is making Bitcoin better to use, better to interact with? What are the other technologies kind of building on that whole stack? And so the way that I view Bitcoin is I have this kind of long-term holding, this very long-term structural view that I occasionally check to make sure that thesis is still in place. But then I use the shorter term stuff, the cyclical stuff, to one, manage position sizes, and then two, set expectations in a near term. And so, for example, I would use, during this past cycle, I would use GBTC as a way to, get in or get out, kind of change my position in that sense. Whereas, like, say, cold storage Bitcoin, I treat more like physical gold, where it's something that you have a structural view on that you almost hold as a separate category. I do think that this recent liquidity pump was a big factor. Now, obviously, Bitcoin has been rising before you got this big March liquidity injection. Bitcoin was so beaten down by the whole, crypto fraud, FTX, all that stuff that happened last year. So if anything, it was earlier this year, you had a partial recovery just because you had super oversold levels. You had a lot of kind of long-term people kind of coming into the market, buying it, pulling it back up. A lot of it also was the dollar index. If anything, that kind of is partially explains the Bitcoin move, because you had, liquidity was getting worse and worse and worse, and you had all these leverage things blow up. But then once you had that kind of liquidity start to stagnate for a period of time, it allowed the fundamental kind of longer term aspects of Bitcoin to start taking over again. But yeah, if you have liquidity roll over again here, I do think you could have Bitcoin consolidate or correct for a period of time, rather than keep going up at the same pace it has been, year to date. I think we're already kind of maybe seeing early signs of that, where we're due for a pause, due for a correction. And I think that'll be heavily tied to partially the economic cycle, partially liquidity, and then especially because both of those are inherently intertwined anyway. If they raise their deposit rates at a very quick rate while they still are not able to adjust their asset side very quickly, then it eats into their profitability. And then they have to do things like either reduce share repurchases, eliminate share repurchases, slow down their dividend growth, maybe cut their dividends in more significant extents, or outright have to raise capital. And so I do think that some of these long tail banks have profitability challenges as long as the Fed tries to maintain rates where they are, and that slowly starts pulling up the deposit rate towards those levels. I'd be very cautious on keeping anything above the FDIC limit in any bank, especially banks outside of the top four, because you never know, you never know where these things can strike, especially because if a bank's, even if it's relatively, solvent on the surface, you don't know necessarily the quality of its loan book unless you've done rigorous analysis on that particular bank. And so any one of these is kind of subject to risks. And I think it's going to be just an ongoing challenge. I separate kind of Bitcoin from the rest of the crypto space.
Yep.
I think the broad crypto space, I think the noise to signal ratio is unfortunately very high. I still think there's a lot of froth that has to bleed out. I think we're obviously seeing more and more regulatory hits against that space. Basically, they define what is a security, which assets have violated security laws, which companies have violated security laws by selling those assets to the public, and so I think that whole space is kind of fraught with landmines going forward. I'd be very cautious around putting serious capital in that space. Bitcoin I put in a different category because it's not a security. It's recognized as a digital commodity because it doesn't pass the Howey test. I also think the fundamentals, that the actual decentralization is more robust, and so I do think that a lot of the froth has already been worked out of the Bitcoin space. A lot of the tourists have gone during this whole kind of catastrophic bear market. There's a lot of interesting development that's happening, both in terms of you can get exposure with the underlying asset, but then also for accredited investors, there's actually interesting, say, VC opportunities out there that I think quite good. But once you go to the broader space, I still think there's a lot that's probably going to bleed out over time in terms of existing froth across the market.